Morning, and a warm welcome to our webinar today, The Importance of Reviewing Your Finances. My name is Susan Pringle. I'm a Director of MHA Henderson Loggie Financial Planning. I hope this morning finds you all in good health and looking forward to Christmas in whatever form that may take for you and your family. Technology seems to be working for me, and I hope you're able to hear and see us. The webinar today is due to last for 45 minutes, and please make use of the Q&A function throughout today's session. This can be found at the bottom of your screen. We hope to address these during the webinar, but if we don't answer your question today, we will follow this up in a future newsletter. There's also a chat function, which you can use to chat with the other attendees and speakers. But if you do have questions, please make sure you put these in the Q&A section. Personally, having spent over 30 years in financial planning, one of the most satisfying things I've been able to do is work with our advisors in helping our clients plan how and when they can stop work. It's a daunting thing to think about, and it seems so far away when you first join the workplace. By the time you're in your 50s, you wonder how thoughts of retirement have managed to creep up so quickly on you. Our plan today, therefore, is to help you review your finances. This is something we recommend you do whether you're new to the workforce or nearing that stage of life when you want to do something different. Make what you do every day your choice. As such, we've taken a relatively typical client inquiry, and my colleague Jonathan McDowall will take you through this in just a few minutes' time. I must point out that the clients are fictional, and any similarity to real people is entirely unintentional. In May this year, our advisors joined together to provide you with an update of how stock markets were performing, and importantly, some tips to help you manage your finances during COVID-19. This webinar is still online and available should you wish to watch this. I'll now pass you over to Jonathan. Jonathan, we spoke about markets back in May, and we're now 6 to 7 months on from there. What's your thoughts on how markets are now performing?
Thanks, Susan. Good morning, everyone. Thanks for listening in. I'm Jonathan McDowall. I'm one of the financial planners here at Henderson Loggie. To answer your question there, Susan, we've got a nice graph on screen showing the FTSE 100 over this year. So you see it's been a bit volatile, as to say. But when we spoke in May, we just seen markets show a slight recovery from the severe falls that we had in February and March. And at that time, it was unknown how the rest of the year was going to pan out. But thankfully, over the last 6, 7 months, it's been pretty positive for investments, to be honest. We've had slight ups and downs, for example, when the effect of the second wave of COVID infections and the further lockdowns and restrictions were imposed, but not to the extent of the falls we experienced in February and March. There's also been some key events that have helped later in this year. So we had the US election, where the result has been viewed largely as a positive one. Hopefully Donald Trump doesn't try to contest that. And we've also had the vaccine news. We've had at least 3 vaccines shown to be, or proven to be, very effective. And we're now seeing this being rolled out in the UK, which is great. And that's really a defining moment. As expected, that investment markets have reacted very well and positively to this. So now that there's some light at the end of the tunnel, that the world can reopen at some point, it's proved to be very positive to many companies in the UK and worldwide that have been badly affected by those lockdowns and restrictions. So following that, we've experienced most investments fully recover from the falls that we've seen earlier this year. And most investments that we're reviewing now are back into positive territory over the last 12 months. Even considering those falls of some 15 to 20%. It's really a quite remarkable turnaround from where we were earlier in the year, and in a sense, not many of us would have thought that may have happened. A comment I would make, as the market conditions are still lower, and if we continue on this positive path and recovery, I would certainly view it as a good time to potentially invest and take advantage of this position. But there's still going to be some tough times ahead. Many companies are struggling financially. We've seen recently the likes of Debenhams, the Arcadia Group go into administration. The Brexit saga we hear about every day is also still ongoing. And that's looking ever more difficult for a deal to be done in time. So it remains important that we have a well-diversified, well-managed investment that can navigate through all of this. And really, this emphasised our message in May, which was to sit tight, remain invested throughout periods of uncertainty like this. And to date, that certainly proved to be the right action to take. And I'd strongly suggest that this approach is what you continue to take. So really, that ties in nicely to the purpose today, which highlights the importance of reviewing your finances, having an effective plan in place, and a plan that can cope through tougher periods like what we're experiencing at the moment. So to start off with, why is it important to review your finances? Well, assess your current position and whether you're on track to meet your financial objectives, and whether the assets you hold are suitable to meet your current and future needs. This year is a prime example of the need to review your finances based on what I've just explained there. And for many of us, a lot will have changed this year, and that might have impacted your future plans. So hence the need to review. For example, you might have been considering retiring, but you're now wondering if this is still possible, or will you have to delay that retirement? Your employment or your business may have been affected, and redundancy could be a possibility, or you may now be considering selling your business. What impact will this have on your finances, and will it mean you can actually retire early? These would be points to review. Due to the impact on investment markets and interest rates, as I've just mentioned, well, you might be wondering if your saving plans are still on track to achieve your objectives as a result of this. So they're just some examples that we've discussed with clients this year as reasons to review their finances and future position. What is a financial plan? Well, quite simply, having a strategy in place to achieve your current and future goals. More than likely, you'll all have some form of aspirations for the future and what you'd like to achieve. This could be retiring early, dreams of buying that holiday home, helping your children go to university, or just having the comfort of being financially secure throughout working life and retirement. Whatever your goals are, you'll have more chance of reaching them by planning ahead rather than just hoping for the best and leaving things too late, as that could seriously impact your chances of achieving those goals. So to add to that, to provide some examples of scenarios which we commonly help clients plan for. These could be scenarios such as saving for a specific goal or event in the future. For example, your children's future education costs. You'll need a plan to assess the sum that you're going to need to accumulate and how much you'll need to save to reach this sum. Could be saving for retirement, and that would be at any stage in your working life. It's important to build up sufficient funds to meet your needs in retirement. Certainly, the earlier you do this, the earlier you plan, the better, the more chance of reaching your retirement aims. So when we look at that, we'd consider, well, how much and where best to save your money, as well as setting some tangible objectives for retirement. For example, the lifestyle you wish to have and the income you need to support that. You may be approaching retirement, and you'll need to plan how you'll achieve your income needs from your available finances and assess whether you have sufficient funds to be able to retire comfortably. For those of you already in retirement, it could be the case that we put in place an effective plan so that your pensions and your finances can last as long as they need to, and you have a strategy as to how best to use that available capital to meet your needs. So that's going to involve assessing your various assets and the best method to draw down on these to meet your income needs over the long term, also in a tax efficient manner. Now, as I've sort of highlighted already, your circumstances or your job position may have changed. That could be redundancy, possibly a divorce or separation. These are times where you're going to need to reassess any plans that you had and whether these can still be achieved or how these now become more achievable, for example. Finally, a common one we look at is planning to reduce tax liabilities. For example, we might create a plan to reduce or eliminate inheritance tax in an effective manner. So all sort of typical and common scenarios that we may work with clients with. What are the benefits of having a financial plan? Well, firstly, it makes you think about the future and what you'd like to achieve. And it allows an assessment of the amounts that you might need to achieve those objectives, and also when these objectives need to be achieved by. Importantly, allow us to set actions to take to achieve those objectives that are measurable and, again, achievable within a reasonable timescale. So what will you need to consider as part of building a financial plan? Well, firstly, you're going to have the emotional aspects. So what do you want to achieve, and when do you want to achieve your aims? What are your future aims and aspirations, both financially and non-financially? How important to you is that you achieve these goals? You might have more than one, for example. So what are your priorities? So you need to put an emphasis on what's important to you and what needs to be focused on first. Are your goals realistic and achievable? That's probably the most important. There's no point in setting a target that's far too high and unachievable. So yeah, that's part of a plan and an ongoing assessment that they are realistic and achievable. But we also need to consider the factual aspects. So what assets do you already have in place towards meeting your aims? So for example, pensions, investments, savings that you already have. Also, are there any liabilities that you have in place that might restrict you or make it a little bit more difficult to achieve your aims? For example, a mortgage and the repayment of this. So debts are always going to be a priority to repay first. And again, that would always be part of a financial plan and looking at that element. Importantly, what income do you have now and potentially in the future against your expenditure? So that's going to identify, well, what surplus income might you have and capital that can then be used towards achieving your longer term aims. And our role in this, well, where we come in as financial planners is to take account of all those points, take account of your circumstances, your assets, your aims, aspirations. And that's not just financial aspirations, as I've already said. So from this, we can review what you have in place already and how close you may or may not be to meeting those aims and needs. Importantly, our role is going to be to confirm those aims are realistic. I highlighted that point a moment ago, but we need to be honest with you if they're not and help help to suggest changes that may need to be taken to those aims. You need to change your plans as necessary to overall meet your needs in the future. So again, really important point. And from the assessment and projections that we'll complete, we'll be able to identify what actions you need to take to address any shortfalls that may be there in meeting those goals. But we'll also identify any changes that may be needed to your pensions or investments that can possibly then help achieve your aims better and possibly quicker as well. Now, a big part of our role, what we can do is, and one of the main ways that we can review finances and create that effective financial plan, is through the use of cash flow modelling. So cash flow modelling allows us to consider your current position and assets whilst building in your aims and goals for the future. And that allows us to project your future position. And within this, we'll take account your assets, your savings, investments and pensions, as well as your income and expenditure. So we'll take account of any large planned expenditure you might have, that big round the world holiday you might be planning at retirement, for example, or anything else, helping out children, house deposits, weddings, etc. So the cash flow projections allow us to use varying rates of growth on your assets to project their future position. And we can also take account of rising costs from inflation. So overall, it provides a realistic projection of your future position. Now, the importance of these projections are they allow us to assess where you stand against these goals and your aspirations. And it then allows us to create and agree suitable actions to meet your needs and overall improve your financial position. So for example, we may need to look at, well, how much more do you need to save to achieve that aim? Or do you need to achieve greater returns on your money to achieve that aim? As some examples. And another beneficial part of this modelling is we can add in what-if scenarios and see how these may impact on your aims and objectives. So for example, what if you retired earlier, later? How would that look? Would retiring earlier be possible? Or do you need to retire earlier because there's shortfalls, for example? What if you went on that round the world holiday? As I mentioned, if we put in these big milestone expenses, are these going to be achievable? Could you actually achieve that dream? And one of the key parts of the cash flow model is to stress test it, and stress test to confirm that the projections stand up to any unforeseen events. Life's never going to be straightforward. We'll know that, so we need to account for that. And everything's not going to move in a straight line. So, as an example, we might consider, well, what if you or your partner died prematurely, or were unable, to work due to ill health? Another example, or just maybe another point on that. That's a really important aspect, because whilst maybe you and your partner have both incomes, things are really comfortable. If something happens to one of you, that could have a serious impact on your financial plans and meeting your income needs, for example, in retirement. So that's quite important and a strong point that we need to look at in detail. Also, what if we were to experience really poor market conditions and the value of your assets were to fall? Would it have an impact on achieving your goals? Would any changes be needed? I guess this year, as I talked about at the start, has been a prime example of that, and the falls in markets that we experienced, but thankfully a strong recovery on the back of it. Overall, cash flow modelling is going to allow us to analyse and interpret your position accurately, and for you, it's going to build a clearer picture of your finances and whether your goals can easily become a reality. And overall, the main result is it's going to allow us to assess where you are against meeting your aims and what actions may be needed to be taken. So, to illustrate all those points I've just explained, I thought it'd be useful if we show an example of a typical review of a client's finances and the use of cash flow modelling to assess their current and future position. So this is just an illustration. It's a typical example of a client that we may have worked with recently or in the past. And in this scenario, they've got to change their circumstances. They wish to consider retiring earlier, and they're seeking our advice as to whether this is achievable for them. So we've got Hugh and Nicole Grant here. Hugh Grant turned 60 this year, so we thought that quite relevant. This example's maybe not got quite the finances that Hugh Grant has himself, but anyway, we thought it was a good scenario to use. So just a little bit of detail on Hugh and Nicole. As I say, Hugh turned 60, Nicole's 2 years younger. They've got 2 children who are essentially grown up and not dependent. He had planned to work to 65, but he now wants to stop work, but not sure if that's affordable for him. A little bit of summary of their assets here. We've got a house value, they've got some savings and investments, reasonable sums there, which is good. They've saved well over their working life. We know they'll have the state pension coming into play at 67, and that's an important aspect to take into account in any retirement provision. Hugh's been earning 50,000, and so again at a good level of income through his working life, and his family expenses are around 24,000 a year. So I guess a fairly simple £2,000 per month income need is what we're looking at there. And they want to live a comfortable life and enjoy a good lifestyle. Is really their overall plans and objectives. When we look at a financial plan, life expectancy is actually really important to consider. So we need to plan over the long term and consider how long your money needs to last. Now, nobody knows how long they're going to be here, but what we've got on the screen here is a printout from the ONS statistics. And what it shows us here, based on Hugh's current age, he's got a 1 in 4 chance of reaching age 92. So that's the figure that we'll use for him. For Nicole, it was age 94. And so we're giving them quite a life, a longevity, as they say. And again, making sure their assets can last that length of time. So if we move on to an example of some of the charts that we would look at and what would be produced from our cash flow modelling software that we use, this is an example here. And what this shows on the chart on screen, it's a year-by-year position of Hugh and Nicole's finances up until that assumed life expectancy of 94. So each column shows the amount of income they'll need, illustrated by the rising black line, and you'll see at different points in time there's some possibly larger spikes. We've put in there 2 larger spikes, assuming they're helping their kids out with the wedding costs in a few years' time, and they've needed to allocate some money towards that. Again, probably a realistic scenario for most people. What the chart also accounts for is the rising cost of living. So you see that black line is ever rising, and that's rising in line with inflation. Now, we heard today that inflation, as measured by the Consumer Price Index, is actually quite low at the moment at 0.3%, but that could easily rise again. Now, within our cash flow models, we can change the plan accordingly to account for such changes as inflation, and that just gives a more realistic picture of your financial position rather than just a static figure for your income need. Now, also in the background, we've got their savings and investments, and they're increasing by rates of interest that we've set and rates of growth for the investments. These can also be changed in the same way to suit a change in climate and circumstances. Software is also pretty sophisticated, so it fully takes account of tax in the background, completing necessary tax calculations through each year of the plan. So we know that tax is accounted for, and again, we know what money is available after tax to meet their needs as applicable. But what this chart shows us overall, and what we interpret from this, is that the assets Hugh and Nicole have, they have enough income and capital to meet their needs comfortably. There's no shortfalls. There's actually capital left over at the end of the plan, so that could have maybe used for some unexpected expenditure that might have occurred during retirement. They could have comfortably met that, or they possibly could have spent a little bit more at various points in time and still have enough assets. What the chart does show to us here, though, in the initial years, the sort of first quarter of the chart, if we look at it that way, Hugh and Nicole have had to draw quite heavily on their savings, their investments, and their personal pension funds to meet their income needs, because they had no other source of income at that point. Hugh does have a final salary pension, but that doesn't come into play until age 65, and that's the little green bars that are shown there. But the light blue and the orange bars in the early years are the withdrawals from their savings, investments, and personal pension funds. What the cash flow model does, and what we do, it draws on the assets initially in the best manner for tax. So we need to ensure the least amount of tax is paid, of course, all part of a good financial plan. And really for us, we'd be assessing the assets that you hold, which are best to draw on first, as well as over the long term. And importantly, that those assets can last over that long-term period. So in this scenario, for example, this involved assessing their personal pension funds to ensure that they could allow access to their fund in a way that met their needs. So in this case, through what we call flexi access drawdown. And that basically allows them to draw an income to meet their needs with the option to vary those withdrawals over time. Now, not all pensions offer this option. So in this scenario, we had to move to a new pension plan for them so that they can have that option. Now, these higher withdrawals were needed up until they both reached state pension age, so I said age 67. Now, after that, the combination of their state pensions, Hugh's final salary pension, that covered the majority of their income needs. And they only needed to draw a smaller amount from those personal pensions thereafter. So to me, this shows the importance of the state pension and how that shouldn't be overlooked as part of your retirement provision. And always worth getting a state pension forecast, if you haven't already, to understand what you potentially will be entitled to. And also, if you're not entitled to the full state pension, are there any years that you can make up and bridge that gap to accumulate more state pension? Now, I appreciate there's a lot of speculation about state pension, and there always will be, to be honest. And there's always potential it may change in the future. That's an unknown at this point in time. So we'll assume on today's figures and what we know. Now, at the end of the plan, it's assumed Hugh passes away a few years earlier before Nicole, the difference in ages, as I said at the start. So she's had to draw, again, quite heavily on those personal pension funds to meet their needs, as there's less income coming in at that point, because we no longer have Hugh's state pension. She would only have part of his final salary pension as well. So, as I said already, that's a really important point with any plan, is to consider the event of one partner dying, and whether that be prematurely or not, and something we need to assess to ensure there would be sufficient funds for either partner on their own, as well as the combination of both. So to further assess this plan, we've also stress tested it. And to do this, we assume that any invested assets fall by 20% in the first year of the plan and every 10 years thereafter. Now, that's quite an extreme test, and we'd hope that would never happen. But it's important to do this to ensure that should the worst happen, you can still maintain your lifestyle and your assets are still sustainable for you. And now in this scenario, even under the stress testing applied, Hugh and Nicole still had sufficient assets for their needs. And overall, Hugh and Nicole should be able to live the lifestyle that they wish and meet their objectives of retiring early. This other chart is just to confirm what I've already said, really, and this shows the value of their liquid assets over time. So that's savings, investments, and pensions. Now, as you can see, they reduced quite a bit in the early years, but then they rose again after state pension age. And when their state pensions, as I said, cover the majority of their income needs. And again, towards the end of the plan, they reduced quite heavily when Hugh passed away. But overall, there was plenty there to meet their needs. And these are the different charts and the different ways that we can look at an individual's finances and plans to assess, I guess, the sustainability of their finances and the plan. And as I say, test that in various ways. Now, what if things didn't plan out as well for Hugh and Nicole? So what if they hadn't been in that financial position? Let's say they hadn't earned as much over their working life, or they hadn't saved as much. So let's assume that both their pension values are lower and also their savings are half the value that we initially used in scenario 1. So they've got less assets available to use, particularly in those earlier years of the plan. And the big difference that we see on the chart on the screen is the red bars. The red bars aren't good. That's a shortfall. That's what we don't want to see. And what we're seeing there, yeah, they can meet their needs in the earlier years, up until around 74, they have enough money, and meaning by that, their savings, investments, and personal pensions. But beyond that point, that money's gone, it's run out. So then they only have state pensions and Hugh's final salary pension. And what we see at that later point in the plan, then those shortfall is ever increasing and becomes much more severe towards those last 4 or 5 years of the plan. So what that really identifies to us is, well, they've not got enough assets, they've not got enough income to achieve their objectives. What could they do in that event? Could they change their living standards? Could they reduce their expenditure, for example? That might allow them to still live a decent lifestyle and have enough assets for their lifetime. That could be an option. Or they might have to work longer. If they worked a few years more, they could accumulate that bit more savings and pension funds, and then they obviously wouldn't have to draw on the funds for as long. So that might allow their funds to last for longer and make it achievable. So in this scenario, it's going to need some careful thought, and some key decisions are going to need to be made in this event. So overall, not a great result for Hugh and Nicole, and they can't really meet those aims of retiring early and having that comfortable retirement that we saw in scenario 1. But, well, actually, maybe just to expand on that, the chart here again is showing their assets, and I guess that just shows the depletion of their assets over time and how they've run out a lot sooner than they would have wanted. So what can we do about that? Well, what if we'd met 10 years earlier? So what if Hugh and Nicole came to me, Hugh's age 50, he's got 10 years to plan in advance, and we'd put in place a proper financial plan at that stage. We would have completed that review of their finances, and we would have completed this cash flow analysis. Now that shortfall would have been identified at that point, and we would have been able to plan or reduce or eliminate that. So, for example, in this case, we confirmed that they had the ability to save more, they had surplus income. So that's great. They've got the ability to try and bridge that gap and eliminate that shortfall. So from the assessment, we were able to calculate that they needed an additional amount of £67,000 to ensure that they had enough assets to meet their needs throughout their entire retirement. Taking that step further, well, what does that mean? Well, we then need to calculate, well, how much did Hugh need to save to achieve that sum of 67,000 in 10 years' time? Well, to him, that was saving £470 per month over the 10 years, to him reaching age 60. And that assumed his assets grew at 3.4%. And yeah, luckily enough, that was affordable to Hugh. He was able to do that. And we were able to agree that where was best for Hugh to save that money as well. Again, that's also important about that assessment of actions to take, how much to save, and then where to save it. Now, the most effective option for Hugh in this case was to save into his pension, because then he benefited from tax relief. That resulted in more money being added to his fund, making it easier to achieve his goal. But he also benefited from a tax reduction through the tax relief, and a reduction in his income tax bill, as he was a higher rate taxpayer. So again, significant benefits, and that's important, a part of the advice and planning that we provide as how and where to save. But the end result shown in the graph at the bottom half of this page, you'll see that there are now no red bars showing, so there's no shortfall. But so by planning early and saving that extra amount, they can live the life that they wanted to live in retirement. And yeah, so a great result. And basically by looking at these differences, it shows the different scenarios that could occur, depending on how you've planned your finances and how early you've done this. I guess that emphasised the point about planning early and being prepared, which your comment I made at the start. It also hopefully illustrates the assessment and projections that we can complete to provide that review of your finances and assessment of where you stand against your objectives. Now, of course, as I indicated, this is just an illustration of examples, example clients, and it shouldn't be taken as advice to your own circumstances, even if this may sound similar to you in any way. We've all got our own individual needs, and an individual assessment is needed for you. So to take this a step further, within our assessment and cash flow modelling, it'll also provide a good opportunity to review what assets you already have in place and to make sure your money's held in the best place and is working for you towards those aims. So to give some examples, you might have several pension pots built up from various jobs over the years. These may or may not be appropriate for you and your aims now. Possibly consolidating these together may be beneficial. This would always need to be assessed in detail, of course. You would need advice on that subject. Another example at the point of retirement, as I sort of alluded to with the example of Hugh and Nicole there, not all pensions offer the same options at retirement and how you can access them. So it's important you assess that and what your pensions can and can't do against your needs to determine whether a new plan, a new pension plan may be needed to meet your needs. Now, you might already hold investments as well, so it'll be important to assess the funds that you hold, their performance, the risk that's taken. As we progress through life and come closer to retirement, possibly we might reduce risk a little bit with investments. And we also might want to assess their ongoing costs. And basically, could these plans be improved to help meet your aims much better, for example? So that would all form part of a review of your finances and may result in reasons to make changes to your existing assets and to better suit your needs going forward. So finally, as part of a good financial plan, it's important to consider making use of your available tax allowances and ensuring your assets are arranged in the best way for tax. And again, I mentioned this when showing the example a few moments ago. But as we approach the end of the year, and the end of the tax year is also not that far away, these points are very relevant. So for example, when creating and reviewing a client's plan, we'd always want to consider areas such as pension contributions. I'd regard these as the most effective tax planning tool, with the tax relief and tax reductions that they offer, as well as allowing your money to grow in a tax-free environment. They're a great way to save and invest capital. Pension funds also remain out with your estate, so should inheritance tax be an issue, that's another advantage. There's always speculation around pension tax relief. I think that's worth a comment, and it could be changed or reduced any time in the future after the impact of COVID and the need for the government to recoup some of their borrowing and spending this year. This could become more of a possibility now. So it's certainly worth considering making further contributions before the end of this tax year, especially if you're a higher or additional rate taxpayer. Now, I'm not saying tax relief will change, but there will always be that speculation. So again, if you've got the ability to pay in more, I would see that as this is a good time to do that. Now, related to that point in pension contributions, we've spoken to several clients this year who've unfortunately been made redundant. In some cases, that's been voluntary, and that's actually been a very good option for some who've chosen to take that option. But in that situation, it's vital that you review your finances, as already described today. It's important to consider what you're being offered as a redundancy payment, and important that you're aware of how that payment could be taxed. Generally, the first 30,000 of a redundancy payment is tax-free, but the remainder is taxable. And what a lot of people aren't aware of is the fact that we have the option to make a pension contribution with this redundancy money. That could either be a personal contribution, or you could exchange part of that redundancy package for a pension contribution from your employer. Now, that's going to provide quite significant tax savings for you, and it really should be considered and looked at. Now, I'd recommend that you take advice before approaching that, and again, assessment of your individual circumstances, what you can contribute, and what would be the resultant benefits. So, but again, part of an overall effective financial plan. The use of your eyes allowance, well, that's something that's common and probably well known to all of us. And if possible, if you can use those each year, then it should definitely be considered. It allows us to save or invest up to £20,000 in a tax-free environment. Now, with interest rates at all-time lows, cash ISAs are much less attractive than what they were. We could say that really the past 10 plus years with interest rates, but more so now, rates are so low. So for me, consideration should be given to using the stocks and shares ISA for monies that you don't need in the short term as a means to provide greater returns also in that tax-free environment. And another common way that we help clients plan tax efficiently is plan to reduce inheritance tax liabilities. So if this was identified that your assets may be affected by IHT, we could prepare a plan to reduce or even eliminate that IHT bill, possibly through the use of gifting assets, investments that may be effective to reduce IHT, or possibly the use of life assurance policies. But a well thought out plan in this area that's prepared early, it can ensure that that plan to reduce and eliminate the IHT bill can be achievable. So look, just some tips and ideas to consider at this point in time around financial planning. And that comes really to the summary for today. And I've highlighted 4 points, I think, just for you to take away from today, that don't leave thinking about your finances to the last minute. It's important to plan ahead. Think about what you want to achieve, not just financially, but in life in general. Review what assets you have now and assess how far you are from achieving your goals, and do that as early as possible. Use a financial planner, as I've illustrated today, to review this with you, using a cash flow modelling example and projections. That'll help to agree appropriate and achievable actions to help reach your aims. But if you feel what I've explained today is relevant and would be beneficial to you, please contact us. We'd be happy to discuss your position in more detail and prepare a suitable financial plan for you. So that really wraps up for what I wanted to say for today. I hope that's been beneficial and worthwhile and informative. My contact details here on the screen. You're happy for you to contact me anytime, email or by phone. I'll pass back over to Susan, as I think we may have some questions that may have came in.
Thank you, Jonathan. I hope everybody did pick up a few tips there on how to create your own plan. I know I reviewed my plans over the last few months, and 2020 definitely stress tested them. Jonathan spoke about interest rates and spending in retirement and mentioned that inflation has fallen to 0.3%. The other headline there was that train tickets are going up by 2.6%, well ahead of where the inflation figure is. So what we do within our plans is we look at historical interest and inflation rates and we build them in. So as Jonathan said, we've covered quite a few questions, but we do have time to address a few more. Jonathan, we've been asked about how beneficial it is to repay mortgages. Hugh and Nicole had already repaid their mortgage, but if they still had a balance based on the original plan to retire at 65, how would this impact on them?
Well, we'd certainly want to look to repay that as quickly as possible. as I said earlier in the presentation, repaying debts is always going to be a priority. A sense could be the highest priority for a lot of people. What I would say, repaying a mortgage certainly wouldn't come at the expense of not preparing for retirement, for example. My view would definitely be have a balance of the two. So if you can make overpayments to a mortgage and bring that down quicker, as well as continuing good worthwhile savings to a pension, yeah, having that balance is going to be the best approach, I feel. At the moment, you mentioned interest rates there. Interest rates on mortgages will hopefully have been beneficial to a lot of people that they'll reduced. That could be an advantage to help repay that mortgage quicker. But that can also lend itself towards, well, if we can achieve a better return on our money with other assets, i.e. in a pension or investment, again, hence considering a balance of the two. But certainly never to be overlooked, in my view, having a balance between repayment of debts and saving for the future.
One other question we've had is how often should we review our plans?
Well, what we would do with most of our clients is review it annually. So yeah, that would always be a good time. It doesn't necessarily need to be that, though. It doesn't need to be as frequent as that. For example, if nothing had changed with your situation, there may not be a need to review, but annually would be a normal suggestion.
That's great. You mentioned obviously that we don't have a crystal ball, do we, as to how the Chancellor will prepare us for getting back into markets and how they're performing. It is a difficult time with regards to that type of thing. But you mentioned about making pension contributions. What's the benefit for higher rate and additional rate taxpayers?
Yeah, so when we make a pension contribution, if we use this on a personal basis, we'll get basic rate tax relief at source added to the pension fund. But for a higher or additional rate taxpayer, they're going to benefit from a reduction in their income tax bill at the end of the year on the basis of the contributions that they've made. So we get a sort of twofold benefit of more money being saved with initial tax relief, and then a reduction in our income tax bill at the end of the year. Important, if you are in that position, if you're not already doing a tax return, you would need to do a tax return to reclaim that additional higher or additional rate relief, or just make a direct claim to HMRC to reclaim that relief as well. And maybe it's an additional point, we would normally make an adjustment to your tax code in accordance with those pension contributions, or there could be a tax refund paid to you as well.
Fantastic. That's some great tips there. Jonathan, thank you. And thank you to everybody who's taken time out of their day to join us this morning. The webinar has been recorded and it will be available to rewatch and share, and we'll send this out to you. Today's underlined the importance of reviewing your plans and making the focus on you. Our contact details were on the last slide and can also be found on our website, hlfp.co.uk. We'd be happy to hear from you, and if you have any questions, please do get in touch. However, enjoy the rest of your Wednesday and take care. Thank you.
Thanks.